Hook. What if the UK's energy crisis sparks a covert tax move or a targeted cash plan, and the government is still keeping all options open? Today I'm breaking down what Rachel Reeves, the Chancellor, is really signaling behind those cautious words and why it matters for your wallet, your energy bills, and the market. Context. We're in a period of volatile energy prices fueled by Middle East tensions and global supply concerns. Reeves says nothing is off the table, but prefers targeted support over broad subsidies. The tension isn't just about prices, it's about how a government balances inflation, energy security, and voter cost of living. My take. This is a high-stakes juggling act, and the decisions could reshape UK energy policy for years. Main breakdown. Idea 1. The spectrum of potential support measures. Reeves mentions targeted support plus broader measures, but stresses it's too early to decide. Personally, I think this signals a phased, risk-led approach. First assess who most needs help, then scale if the shock persists. What makes this really interesting is how policymakers weigh inefficiencies and market distortions versus direct relief. In my opinion, the emphasis on targeting could preserve fiscal credibility, while still providing a safety net if prices stay elevated. A detail I find fascinating is the tension between helping households now and avoiding long-term market distortions that subsidies often create. If you take a step back, this reflects a broader trend. Governments preferring precision over broad subsidies in volatile energy cycles. Idea 2. Fuel duty question as a lever. The question of whether to nix or delay the 5p fuel duty rise scheduled for September is left open. From my perspective, this shows political pressure converging with price signals. Any change now could ripple into transport costs and inflation expectations. What many people don't realize is that fuel duty changes aren't just about petrol at the pump. They influence retail pricing, logistics, and even form the political calendar ahead of elections. If you consider the timing, delaying a rise could buy political breathing room while signaling restraint, yet it also postpones hard choices about funding energy policies. One thing that immediately stands out is how this becomes a litmus test for fiscal discipline under stress. Idea 3. Market dynamics versus government intervention. Reeves argues for competition and transparency at forecourts rather than government-funded subsidies. What this really suggests is a shift toward letting markets respond to real-time price signals, with regulators watching for profiteering. In my opinion, this highlights a deeper question. Can better information and competition deliver relief faster and more sustainably than temporary subsidies? A detail I find fascinating is the role of the CMA in monitoring pricing, which could deter anti-competitive practices and keep pump prices closer to true wholesale costs. This ties into a bigger trend. Policymakers leaning on market mechanisms to manage shocks rather than plugging gaps with tax-funded relief. Idea 4. Energy security as a global risk calculus. Reeves points to de-escalation of the Iran conflict and cooperative actions with the IEA, including oil reserve releases. From my view, this frames the UK's approach as inseparable from global risk management. What this means is that domestic policies can only do so much if international supply lines are unstable. A common misunderstanding is to treat energy prices as purely domestic. The real driver is a network of geopolitics and reserves. Idea 5. Green energy investments boosting resilience. Reeves asserts Britain's renewable energy investments reduce exposure to volatile oil and gas prices. What this implies is a longer arc. By accelerating green infrastructure, the country could better weather shocks and possibly lower energy price volatility over time. The nuance here is that the short-term politics of relief and the long-term economics of decarbonization aren't at odds. They're two sides of the same strategy. A detail I find compelling is how grid connections and storage capacity translate wind and solar into steady energy pricing, rather than reactionary spikes. Deeper insight. The common thread here is risk management under uncertainty. The government is signaling readiness to pivot between targeted relief, market reforms, and strategic reserves depending on how the Iran-era crisis unfolds. What this could mean for you is that prices at the pump might remain volatile in the near term, but the path toward greater energy resilience hinges on competitive markets, transparent pricing, and smarter infrastructure. If we zoom out, the narrative is about balancing immediate cost pressures with longer-term transitions, and how the political calculus adapts as the global energy map shifts. Closing thought. The core question isn't simply whether to cut a fuel duty or throw cash at bills. It's how a nation negotiates price shocks with credibility, fairness, and a believable plan for a cleaner, more stable energy future. As a viewer watching this play out, ask yourself, will targeted support and stronger market competition be enough to shield households, or will geopolitical risk still overwhelm domestic policy? Let me know which option you think Britain should prioritize and why in the comments.